Well, Brian, I'm curious too, obviously you've got your loyalties to the Devils. Do you think there's anybody out there that can stop the Bruins and just the torrid pace they've put on the season? I know they're in quite a series right now, but
If you're looking at a team, you got to look at Toronto. If they pull this victory out over Tampa Bay, it's going to be a whole new series for the NHL. You have a bunch of new teams coming in here between the Devils, the Toronto, and on the West Coast. If McDavid can get that team going, it's going to be a great series.
oh, for sure. I definitely I went for a couple long shot bids and maybe put a few dollars behind the Winnipeg Jets and Edmonton Oilers too.
Yeah.
But
You just
I don't
can't
like
rule
being
out McDavid. He's like nothing I don't think any professional sports has ever seen. He's just in a small market, so most people don't know him. But he's phenomenal.
Well, do you like the action now in the game compared to the rules updates they've made in the last couple of years too? Just as far as more offense?
I love the more offense. The only thing I would like to see more from the NHL is less contact with the goalies. That's always been it. Granted, I was a goalie, my kids were goalies. You just lose too many kids at all levels with the amount of impact. These guys are flying. I'm old, so what you see then compared to now, it's completely different. The level of impact now is much greater. The equipment that they're wearing is a lot harder, to protect them. So when they have contact with a goalie, you don't want to lose an $8 million goalie. Sorry, it's gets pricey.
For sure. And just the appreciation of the speed of the game. You see it on TV, but to be there in person and visualize it firsthand, it's a whole nother level.
It's a whole different level. Yeah. It's a whole different game.
Rob, I know you're quite the hockey aficionado, so
does hockey have an E in it? Anyway, I could talk a little bit about the Warriors game tonight, which should be good. But we should probably get into fun things like loan level price adjustments.
So, Tom, absolutely, yeah. So welcome everybody into the Stanley Cup prognostication version of the rundown here. Tom Gallucci, Mortgage Collaborative, as always. Rob Chrisman. Rob, I'm going to ask you where you're at today with that beautiful portrait in the background. But first off, I want to introduce our co-host for this afternoon. We have in Brian Benjamin, who is the president with Two River Mortgage and Investment based out in New Jersey. Had some of the Devils talk in the lead into this conversation. And Brian is a 25-year plus mortgage banking and broker vet, specializing kind of in this jumbo and super jumbo focus, but also very active on the regulatory affairs side within our industry. It's the director of the NJPMO trade group representing New Jersey real estate mortgage and appraisal professionals, National Association of Independent Housing Professionals in the New Jersey chapter, as well as government affairs chairman there, I should say.
And that was former, but yes.
Right. And New Jersey Banking and Consumer Finance Advisory Board. And then, Brian, you were also just recently appointed through AIM as the state captain for New Jersey. So you're a busy guy.
We'll see what that, yeah, you need something to do in the spare time.
Right. So Brian, let's just since you just brought it up, how are pipelines out there? How's the loan volume? Is it scary slow? Or are you starting to see a little bit of a pickup? Or do all the deals have hair on them? What's it like from a loan originator's perspective?
It's it's an ever-changing cycle, and we've always gone through these cycles. We had the ones in the 90s, 2000s. You're going to always see cycles up and down. I was fortunate. I didn't really see the slowdown until probably the end of October going into November. It got very quiet from then through February. Since beginning of March, I have seen a huge pickup in business. It's all purchased. Don't see any refis lately. But every one of the purchases is difficult. They're all getting outbid. You know, you have multiple offers. Every person I have right now probably had 8 to 10 deals that they lost, some even more than that before they finally found a home. You know, it's the inventory is continually the problem. We're down, you know, it's everywhere. And you've written about it in your morning blurb there about NAR putting out how many houses are for sale. And I think you said that there were like 450,000 houses for sale on the MLS at any one time. And we have like what, 1.4 million realtors. So that doesn't bode too well there when you do doesn't keep you employed, doesn't keep the food on the table for some of these folks. But you're going to see that. Historically, the counties I'm in had 16,000 houses on the MLS. Right now, under $1 million, the county I'm in only has under 400 that are not listed or pending. And you know, it gets difficult when you're in a county with 800,000 people doing that.
So I know you split your time between New Jersey and Florida. Do you follow the Florida market as closely? And if so, what's going on there?
You know, you try to. I have a house down there, so I can get a feel for it when I'm there. Broward, Miami-Dade, West Palm Beach County, Palm Beach County, that whole area is just booming. I've never seen it as busy it is the last 3 years. It's still going. It's amazing how many homes are selling at the higher brackets. The amount of cash that's flowing into South Florida is just amazing. I hope it keeps going, you know, good for them.
Yeah. Are you finding that in Florida, the locals are priced out of the market by people coming down from, you know, Illinois or Michigan or the Northeast?
I'm seeing two different scenarios, and I'm seeing it in both locales. Is most of the people that are moving are downsizing, so they have an abundance of cash to go to Florida, to go wherever they're going, and they can utilize that cash to an advantage. The other ones are people that are selling their home here begrudgingly because they don't want to lose their 3% rates, but they already have a home, a second home somewhere, and they're going to the second home. And I see that a lot. That's probably the more common thing right now. And it's one of the only reasons I see people selling their home. They already have someplace to go.
Interesting. So let's talk about good old FHFA loan level price adjustments. I wrote about them today. There's a lot of press about them. It's become a political issue suddenly, or maybe not so suddenly. You know, some originators will point out that they started to see trouble late last year in 2022. But, you know, May 1, some changes take effect. Other changes have been delayed until August. And I know that you love rolling up your sleeves and getting involved in some of these price level, loan level discussions. Overall, what is your take on the changes that are taking place or about to take place?
You know, it stunned me that I'm actually saying this. I agree 100% with the former head of the MBA, Dave Stevens. This should not be politicalized. This is just, it's business. At the same time, you know, look, we're always going to have loan level adjustments, and it should be for risk. That's what my understanding of FHFA and Fannie and Freddie is that they're market makers. They're not the government, as far as I'm concerned. They're private corporations that are held in conservatorship versus FHA, which is under HUD, which is a government agency. And, you know, to be doing it for the purpose that's being out there publicly, I just don't get why they're doing that, because you have FHA over there lending to, let's call it, the lower economic groups. Why are they trying? You know, I don't really understand this, and I hope it doesn't impact them negatively financially. I get that they're getting it from one side and putting it to the other, but you still have that risk, and the risk is always going to be there to the lower groups. whether
Do
they're
you,
down less or lower credit scores.
do you ever, when you're pricing out a scenario, does a $500,000 loan ever look better through a jumbo program rather than a Fannie Mae or Freddie Mac program because of the G fee or because of the loan level price adjustments?
Not that I've seen lately. No, not yet. You're seeing some people trying to go to the ARMs, and we had all those issues back in 08, 09, and even before that with the adjustable rate mortgages and everybody complaining that, oh, I wasn't aware when they were coming due, and they just happened to be coming due in, let's call it 08, 09, 2010 time. And it was a negative detriment to the industry to have to deal with that publicly. And, I almost want to tell people, if you're going on an ARM, have the people write a letter that they know they're going on an ARM, have them put it in handwriting, because, the same with the 2-1 buy downs and the 3-1 buy downs. It's another, yes, they're getting a benefit up front, but if things turn, where are these people going to be and how are they going to respond publicly? But I don't see really where there's anything outside of Fannie and Freddie. I thought it was great that Fannie and Freddie increased those loan limits as high as they did, at least in the Northeast. It's amazing how many people I have that are going close to that 1,089,000 number in our area. I wished it was more like that down in Florida, to be honest with you. We just did one. Fortunately, they were able to qualify under the doctor program, but they just did one on an 850 purchase in Florida, and you couldn't go on that program on a Fannie Mae loan down there. It exceeded their limits. And, for two doctors starting out, it's all relative, I guess, but for the two people starting out in that income bracket, 850 wasn't really a big house. But there's no other programs for them.
How about, a year ago, before the yield curve inverted, we had, banks and credit unions, and they had these, intermediate ARMs, 3-1, 5-1, 7-1s that were just had amazing rates relative to 30-year fixed rates. That's corrected itself somewhat. Are you doing much in the way of jumbo intermediate ARM loans?
The only ARMs I'm seeing are for the doctor programs, and they're higher than most of the 30 years. It's, with this inverted yield, there's just not a lot of ARM product out there. I would imagine that you would see more if you were doing private banking. But I don't know how prosperous that area is right now, or how plentiful that area is right now. Because most of those people, like I said before, most of those people, they got their 3% rates. They're not going anywhere. And to try and to move into that market, it's very difficult right now.
What, without trying to, we're going a little bit off script here a little bit.
Right.
I'm sure you don't mind. But in terms of getting your name out there, I continue to see, as I travel around, as you mentioned, problems with inventory, scary quiet is a term I've heard from a few originators who are doing, a lot of loans, and now they might have just a handful in their pipeline. How are you getting your business? Is it all through referrals? And like you say, without trying to steal your secret sauce and so forth, where's your business coming from?
I have no problem sharing that. I'm getting 100% of my business from realtors. I would have to say that's probably the first time in my 35-year career I can say that, but that's been going on for over the last year. Really, as things petered off, let's call it last year about this time, everything has been 100% realtors. What I've been doing is developing young realtors and quasi teaching them on how to sell homes and how to get clients. And it's worked out and it's helping.
Getting back to basics, right?
Yep.
As we talk about this regularly on the show with originators that may be newer to the industry or had gotten in since this last refi boom the past couple of years, having to really generate those partners.
Yeah, we have gotten stagnant because we became so it was so easy to get loans for the last, even the last 5 years. It's been real easy to get loans. And a lot of these young guys coming into the industry, guys and gals, I should say, coming into the industry, they don't understand how you have to go out and continually recreate yourself really every 6 months is really, and I don't want to say you need a new stick, to use an old term there, but you need a new thing every 6 months, come up with something different. And it's just a new presentation of you.
And kind of fresh perspectives to take back to those referral partners, your centers of influence, and just refining your craft, right?
Just refining your craft and reaching people in a slightly different way. You know, I started doing open houses almost every weekend now. And, you know, for multiple reasons. I enjoy meeting people.
Mhm.
It's, I don't want the realtors that I know being alone in a house. And I think it's not wise whether they do two realtors, or they have one mortgage person and a realtor. But one of the easiest things I started doing was going to Costco and getting the big boxes of Goldfish crackers. They come in little bags. I give them to all the kids. And I glue or tape one of my business cards to the back of it. And I'll tell you what, every single parent walks out of that house, they have my business card. The simplest thing. And the reason I started doing the Goldfish, I originally started with candy bars, but they throw out the wrappers. When you give the kid the Goldfish thing, it goes in it's a little bag, it goes in the car,
Right.
and mom and dad finds it there the next day when they're cleaning out the car. They still have it. And I can't tell you how often this has worked. And it's a simple little thing, but you have to recreate yourself like that continually.
No, it's a great point. It's really smart ways of thinking outside the box, but not overcomplicating it to leave a lasting impression and continue to drive those opportunities. To your point, I think we see sometimes, or hear through our network, folks will, based on the market cycle, fall back to those trends of cultivating their referral partners and centers of influences, and then the refi start up and the phone starts ringing off the hook, and kind of stop that continuation of the, cultivating those practices, and then you almost have to start from scratch again when the refi pipeline dies out. You've got to go back to sourcing that purchase-based business.
Yeah, it's the stuff I hear from other loan officers, and I've been doing this for almost ever, I feel like, is it's amazing how many people out there are going, well, I don't answer the phone on the weekends, or I don't answer the phone, and it drives my kids nuts. It drives my wife nuts. Phone rings, I answer it. I don't care if it's 7 a.m. or 10 o'clock at night. And that's a big thing when you're in this industry. I know you're going to get some people that are, not your favorite clients, but you know what? You pick up the phone and you take care of it right then and there, and you quell the problem before it matriculates into something much larger. Because if they sit there and think about it overnight, it's just going to swell and swell in their mind. And it's something you probably could have just put the fire out right away.
No, and fantastic point too. I mean, that's a great practice in general, but especially in our industry, and we talk about it a lot with different lead generation providers, whether more traditional forms or through tech platforms. And they always harp on, speed to lead, and that ability, to your point, that call comes through, or that email or text comes through, your ability and your percentage of being able to foster an application or close a deal is going to all be based on how quick you're picking the phone up or responding to it before, they're on to one of your competitors.
Rob put something in there today that in your article today from CFPB, that 75% of consumers only go to one lender. Now, I don't know if CFPB wants them putting multiple applications in at the same time. I know I don't, and MBA doesn't want, because that's just a recipe for fraud coming down the road. But, just taking that aside,
right,
something that a loan officer should be held aware of, that if you don't get them at the point of contact as a client, they're going to go somewhere else. And once they're there, they're not going to they're not going to move that easily. I was talking to a loan officer down in West Virginia last week that he picked up a realtor because she kept calling a loan officer, and he said, well, I don't take pre-approvals over the weekend, and I'm busy until next Thursday. And she called him, he did it right away. And, he has a new agent now that's not going to go back to the other one. And once you have that relationship and you develop it, it's yours for life, or yours to lose, I should say.
It's great points. There's just too much opportunity at the consumer's fingertips with their mobile devices. They can move right on from you. And Rob, I feel like Rob keep coming in and out. Maybe he'll join us back in at his full capacity in the interim. We're on the
I'm
rundown.
sorry.
Oh,
Can you hear me now?
I can. I miss your smiling face, but
All
I
right,
can hear
I
you.
apologize.
There you are.
You can't see me?
There we are.
I'm sorry. It's the corporate internet box that's on the wall. I have to run over and put quarters in.
Just punch it a couple times too. That'll get it firing at 5G speeds. But
Yeah. While I'm here, while I'm on.
Oh, there he goes.
oh, we got it. Yeah. Well, audience, if you've got any questions, myself, Rob, Brian, certainly encourage you to put those into the chat. But one thing you mentioned earlier when Rob was kind of asking you about the Florida market,
Right.
I know it was in his commentary earlier this week, Florida imposing the 1% emergency fee on property insurance premiums, just kind of due to
So sorry.
solvency.
Sorry about the
No worries, Rob.
Brian.
Yep.
FHFA is very interested in first-time home buyers. You must have first-time home buyers across your desk regularly. How do you handle them differently than, say, another home buyer or somebody you've worked with in the past? Do you have to feel personally obligated to educate them? And if so, how do you do that?
Freddie Mac has a great program, that SMART program. That and I know they have it through UWM. I'm guessing other lenders call it something else, which is in my mind is a great program for first-time home buyers. It's just it works so well because it requires them to take a class, and they actually get money towards closing costs if they do it online or on a phone with someone, where someone's actually back and forth with them, rather than them just pushing the buttons on the computer and beating up the computer. They're not learning as much. It's a good program. It gets most of them in. Every program out there is a tool. Some of them are benefits, some of them have downfalls to them. But if you use the tool for what it's worth, my dad used to tell me, you can cut a board in half with a saw, or you can use a hammer and screw. The saw is going to work better. That's really what you're doing with every mortgage program, is you're trying to use the right program for that consumer. And, when you try to wedge them into the other one, it doesn't always work. They have a great program at both Fannie and Freddie for the first-time home buyers. Yeah, there's stuff I wish they could do that would work better. At the same conversation, I was recently, in fact, about 3 hours ago, if that's recent enough, I was having a conversation with a state senator about one of the bond funds for the states, because they won't allow brokers to have access to these bond funds for the mortgages. They'll only, in this specific state, they'll only do it through certain lenders. And some of the lenders are, they're lenders that have already announced that they're backing off from the industry, they're backing off from lending, or there's another one that has both a TPO and a retail side, but their retail side's a point higher in the points, not the rate, than their wholesale side. And, you're trying to explain this to government people, and they don't really see the benefit of why you should go to the TPO side sometimes. And, it's the same thing for the consumer. You want to give them the most options, whether you have Fannie, Freddie, FHA, you have to sit down and spend a couple minutes educating each one of them. I just did one, it was actually for a realtor that she has a 720 credit score, but she was winding up better off going on an FHA loan. She needed the cash and it got her a much better rate. And with the new MIP coming out of FHA, I expect to see a lot more of that with people going on the low down payments. You know, I understand, and I'm guessing part of what's going on with these loan level pricing adjustments is to kind of offset that MIP change, or the monthly MIP change at FHA, so that it balances it all out. But other than that, I really don't understand the change to the loan level pricing adjustments.
So along those lines, Brian, I want to ask you, you've been in the business for decades, since the Truman administration. And how has being a loan broker, mortgage broker in New Jersey and in part Florida, how is it different now than, say, 10 years ago? Or is it different?
I don't know if it's different in the fundamental. I mean, yeah, you have all the regulatory changes, but at the same time, the industry just adapts. You know, everybody's screaming and yelling. And look, I'm the first one to tell you, if you saw a lot of that stuff that the federal government was looking at doing back in 08, 09, compared to the way it was actually finally presented, it's much better the way it came out. Sure, they could make a lot of changes that would make it better. But if they give you the ground rules and everybody understands the ground rules, you can play by them and you can prosper by them for both our side and the consumer side. And if everybody's benefiting, that's the end goal for everybody. It's, you know, it's always going to change. If we don't have change, then we'll be sitting here back in, 1970, where you were, everybody was getting charged 1 point and you had one rate, and you could get a 30 or a 15-year. I forget when Atima came out, I think, what was it, 79, that gave us the adjustables. But before that, you really didn't have much of that.
Yeah. Well, certainly the industry has changed from a regulatory perspective. And you're right. This industry, there's a lot of hue and clamor, as they say, when things happen with regard to ability to repay. Oh, it's going to kill the industry. Oh, TRID. Oh, it's going to kill the industry. Oh, the new 1003. Oh, it's going to kill the industry. And yet people continue to need home loans. And somebody, like I'm fond of saying, somebody has to be around to do $1 trillion or $1.5 trillion or $2 trillion worth of mortgages. And, as companies consolidate or the industry landscape shifts a little bit, companies adapt and loan officers adapt. And it's not quite the way it was 5 or 10 years ago, but we're still making home loans, I'll tell you.
Absolutely.
So,
I mean, one of the things that shocked me, and at first it shocked me from your right this morning, was that MBA, the numbers of originations, and that they're saying that we're at 1.8 trillion is their estimate for this year. I think it was 1.8, right? Was it 1.6 or 1.8? I think it was 1.8.
1.8,
Yeah.
which a lot of people think is high, but we'll see.
At first I thought, wow, that's really high. I'm thinking, it was going to fall below $1 trillion even, initially. And now I'm sitting here going, when you compare it, yes, it could hit that number, but I'd love to see the number of units rather than the dollar amount, because, I'm looking at some homes in my area that were, say, 250 3 years ago, pre-COVID, that are now 550. And you're going, okay, if you're doing a mortgage on that, how much, you're still doing the same unit, but now you're almost doubling the value of them. And I don't know if that's where the number is, or if we're actually getting that many loans out there. I mean, I know people are still buying. They're all, we used to have a saying, people are always going to buy, people are always going to sell. It's just like you saying, people are always going to need a loan. They are. And someone's going to step in and fill that void because there's money to be made.
So, Brian, I'm not scolding you, Brian. And I know we only have a few minutes left, but Wednesday, a couple of days ago, I did have the units. So, and I'm reading it off my
did you?
email.
Okay, I'm sorry.
No, I'm not scolding you. So the industry did 13.7 million units in 2020, 14.2 million in 2021, 6.4 million in 2022. So less than half
Right.
prior years estimated for 2022. And the thinks we're going to do 5 million units this year or in 2023. So down about 2/3 unit wise from a couple of years ago. And the point that I was making in the opening paragraph was, had any downsized to match a 2/3 drop in units? Because as you know, if you're a dock drawer, whether you're doing $1 million set of docks or a $200,000 set of docks, it's kind of the same amount of work. So yeah, units are very important.
Yeah, I mean, you look at those numbers, you're down 2/3 in the numbers, but you're only down what, maybe 20%, 25% in the volume?
Yeah, volume, the loan amounts have definitely gone up.
Right. Oh, absolutely. And one of the things I was talking to the state senator about is in New Jersey, we have a mansion tax. And it's for any property over $1 million, they charge 1%. And I was quasi joking because this went in like 10 years ago of how quick the typical home is going to be approaching $1 million. And are they going to adjust these mansions tax? Because at some point, your starter home at the rate they're going around here is going to be, approaching that number. Your typical home now is getting close to $1 million.
I mean, it's a great
Call it your
point.
starter home, but it's a typical home.
Right. And even outside of, higher value markets on the coast or in some of these hot button cities. I was in an Uber ride yesterday in Nashville and the driver asked me, she's like, I want to purchase a second investment property, but I want to see if housing prices are going to fall back to pre-pandemic levels beforehand. Said every indicator we see, it doesn't show that. If anything, it probably stays about flat. And you would imagine too, as demand picks back up with supply, that it just continue to increase again.
This is a common, when I do the open houses I was talking about, that's a common question. And all I can keep coming up with is if you took a $400,000 loan out, and I'm using rough numbers here and I shouldn't, but I'm just going to use rough number. If you took a $400,000 loan out, call it sub 3%, you're around $1,600 a month. Now you're over double that. So what's going to be the incentive for you to sell that house and take a mortgage that's double? Just to get to the same place, never mind going to the next size home. And personally, I just don't see it. And that's part of the reason we don't have the inventory. But what's going to be the incentive for people to move? And, we still have the cap on the $10,000 cap on real estate taxes. And all these numbers are fixed. As you look to move into the bigger home, you're going to be losing tax deductions and you want to see the mortgage payment double. I just don't see the incentive for people to leave their homes.
Right. I agree.
Spot on. And Bernard, who from iMergent, who co-hosted with us a couple weeks ago, dropped in the chat too that through their analytics, they're forecasting drop in purchase loans about 15% in 23 versus 22. 3.5 million in 23 versus 4.2 million in 22. So appreciate that, Bernard. I couldn't tell if Rob was frozen or if he was dying to ask you a question, Brian. But if it's the latter, I know we're about to wrap up here with this Friday's edition of the Rundown. So as we were kind of talking in the lead-in about Stanley Cup coming up tonight, I know you're projecting your Devils to take Game 6 tomorrow in the first round of the playoffs. How far will they go?
Oh, it depends on, both teams that they're looking at, or the three possible teams that I see. The Bruins, Toronto, or Tampa Bay. If they wind up against any of those, it's going to be extremely difficult. Look, Jack Hughes is just phenomenal. I don't want to call him as good as McDavid. He's got some growing to do, but he's one of those kids. It's like coaching a kid in Pee-wees. You can see the growth every 2 weeks with him. And it's
Yeah.
just, it's amazing to see this kid grow. And supposedly his little brother's even better. I know.
That's scary for the league.
They played him 2 games and it was, he went right through one team. It was just amazing. Great to watch. There's a lot of good hockey out there. If people aren't into it, I'd tell them to grab some tickets and go to a game. It'll be the best thing you ever did in your life.
Couldn't agree more. The in-person experience at a hockey game blows away whatever you're watching at home on your TV. And Rob, are you back with us? Because while you're away, maybe not. So quick shout out to the audience. Rob says Warriors in 6 tonight. So if you have a local sports book, it's legal in your state. Rob will match whatever you put on his Warriors if you lose tonight. So
Commit him while he can't defend himself.
that's exactly, Brian. That's exactly the point. Rob's good for it. Well, on that note, Lisa says Seattle Kraken in 6 tonight. Like the predictions out there. But Rob, if you're back with us, any final parting notes? I've put you on the hook for some bet matches on your Warriors tonight.
Can you hear me now? Can you see me now? So I apologize for the internet, but I don't know if you can see that, but going to the game tonight. Very excited about that. And yeah, I think it's going to be a good game. I mean, it's been a great contest. Both the Kings and the Warriors are very, very good. They're scrappy teams. So anyway, looking forward to the game tonight.
Well, win one for the Dubs tonight. Well, on that note, we'll call it for this Friday. Brian, thank you so much for joining us.
Anytime, my friend.
And thank you very much.
It's fantastic.
Thank you very much, Brian.
You have a great
To
weekend.
our audience, catch us on YouTube for the on-demand version, as well as podcasts on the audio side, wherever you get your podcasts, or join us live next week, because we'll do this again next Friday, 3:00 Eastern. But until then, thanks so much for joining. Have a fantastic weekend, everyone.
Take care.